Just as oil prices seem to be easing, with many analysts predicting a period of relative calm, the market has delivered a sharp and unexpected twist. For weeks, there was a sense of cautious optimism among traders and consumers alike, as the cost of crude oil appeared to be stabilizing after months of turbulence. Headlines spoke of potential relief at the gas pump, and some even speculated that the worst of the energy crunch might be behind us. But in a matter of hours, the market has snapped back, erasing recent gains and reminding us all just how quickly sentiment can shift. The volatility that defines the oil market has returned with a vengeance, catching many off guard and forcing a rapid reassessment of the global energy outlook. For 2 weeks, prices dipped, hinting at relief for consumers and businesses struggling with high energy costs. This downward trend was seen as a sign that supply chains were recovering and that geopolitical tensions might be easing, at least temporarily. But as August 22, 2025 closes, that optimism is gone. The mood on trading floors has shifted from hope to anxiety, as the reality of renewed instability sets in. The end-of-day numbers tell a story of a market in flux, with uncertainty once again dominating the conversation. The main driver? Ongoing conflict in Ukraine with no peace in sight, continues to rattle global energy security. Each new development on the battlefield sends shockwaves through the markets, as investors weigh the risks to vital pipelines and infrastructure that supply much of Europe and beyond. Investors and governments are bracing for more instability, as the hope for diplomatic progress has vanished. Behind closed doors, officials scramble to develop contingency plans, while analysts pore over data, searching for any sign of a turning point. The uncertainty is palpable, and the stakes are higher than ever. The price of oil is more than numbers, it's a reflection of global conflict and uncertainty. Every uptick and downturn tells a story of supply fears, shifting alliances, and the fragile balance that underpins the world's energy system. For millions, these numbers translate directly into the cost of living, the price of goods, and the stability of economies. This bounce-back signals the market is preparing for continued disruption. Traders are hedging their bets, companies are reassessing their strategies, and shipping routes are being reconsidered as the world braces for what could be a prolonged period of uncertainty in the energy sector. Next, we'll break down the key factors behind this reversal, from the battlefields of Eastern Europe to the boardrooms of central banks. We'll explore how geopolitical tensions, economic policy decisions, and the ever-present threat of supply disruptions are shaping the future of global energy and what it means for all of us. The Russia-Ukraine war, now in its 4th year, continues to cast a long and persistent shadow over global energy markets. What began as a regional conflict has evolved into a crisis with far-reaching consequences, affecting not just the countries directly involved, but economies and households around the world. The devastation in Ukraine is visible in shattered cities and displaced communities, but the ripple effects extend far beyond the battlefield, reaching into the heart of international trade and energy security. Russia's role as a major oil supplier means any threat to its exports sends prices up. The country is one of the world's largest producers and exporters of crude oil, and its vast network of pipelines and shipping routes is crucial for meeting global demand. When these supply lines are threatened, whether by military action, sabotage, or sanctions, the impact is felt immediately in the form of price spikes and market uncertainty. Even rumors of disruption can send shockwaves through the energy sector. Hopes for peace have faded as violence escalates. Recent attacks near the EU border and strikes on Russian refineries highlight the risk. Each new incident not only damages critical infrastructure but also heightens fears of a broader conflict that could further destabilize energy supplies. The destruction of refineries and pipelines has forced companies and governments to scramble for alternatives, driving up costs and increasing the risk of shortages. Diplomatic talks are stalled, with no summit in sight, deepening the divide. The lack of meaningful dialogue between Russia, Ukraine, and their international partners has left the world in a state of uncertainty. Without a clear path to peace, the prospects for resolving the crisis remain bleak, and the risk of further escalation looms large. The diplomatic vacuum has made it difficult to coordinate a global response, leaving markets to react to every new development with anxiety. This deadlock signals ongoing risk to energy supplies, prompting the US and allies to consider tougher sanctions. Policymakers are weighing new measures to pressure Russia economically, but such actions come with their own set of risks. Sanctions can further restrict oil flows, exacerbating shortages and driving prices even higher. At the same time, Countries dependent on Russian energy are searching for alternative sources, reshaping global trade patterns and alliances. Every new attack or failed negotiation adds to oil's risk premium. Traders and investors are forced to factor in the possibility of sudden supply disruptions, making the market more volatile and unpredictable. The uncertainty has led to increased speculation, with prices swinging wildly in response to headlines and rumors. This heightened risk environment makes it difficult for businesses and consumers to plan for the future. As long as the conflict drags on, oil prices will remain highly sensitive to developments on the ground. Military movements, diplomatic statements, and even unconfirmed reports can trigger immediate reactions in the market. The presence of armed guards and military convoys near key infrastructure underscores the ongoing danger and the high stakes involved. For now, stability remains elusive, and the world watches anxiously for any sign of change. The world must brace for continued volatility and financial strain. From rising fuel costs at the pump to falling stock prices and economic uncertainty, the effects of this conflict are being felt everywhere. As the situation evolves, governments, businesses, and individuals alike must prepare for a future where energy markets remain unpredictable, and the shadow of war continues to loom over the global economy. Let's look at the numbers driving this week's oil rebound. Brent crude futures climbed to $67.79 a barrel, while West Texas Intermediate hit $63.65. Both benchmarks reversed previous losses, with Brent up 2.7% and WTI up 1.1% for the week. This ends a two-week losing streak, fueled by renewed geopolitical fears. The synchronized rise in both benchmarks shows the market's consensus supply risks now outweigh demand concerns. The hope for peace and economic slowdown faded. Now supply disruption fears dominate. As long as Ukraine's conflict persists, expect more price swings and volatility. The market is signaling a tighter, more uncertain future for global energy. Why is peace so elusive in Ukraine, and why does it matter for oil? Russia demands Ukraine cede the Donbas region and abandon NATO ambitions, non-starters for Kyiv. Ukraine refuses to surrender territory or sovereignty, seeing it as a betrayal and a dangerous precedent. Both sides are entrenched, believing battlefield gains are more likely than diplomatic compromise. This deadlock means the conflict and its impact on oil will drag on. For markets, this is a recipe for ongoing uncertainty and risk. The risk premium in oil prices reflects this diplomatic impasse. Until positions shift, expect continued instability in both geopolitics and energy. U.S. events are also shaping oil prices, especially the latest crude stockpile data. Last week, U.S. inventories dropped by 6 million barrels, triple what analysts expected. This surprise signals stronger than expected demand in the world's largest economy. When U.S. stockpiles fall sharply, it tightens the global market and pushes prices up. The U.S. is both a top consumer and producer, so its inventory swings matter worldwide. This robust demand, combined with Ukraine's instability, is driving prices higher. The sudden halt in the two-week price decline is a direct reaction to these factors. A bullish market emerges when supply fears and strong demand collide. That's why oil's rebound has been so swift and dramatic. Beyond the immediate headlines of supply disruptions and geopolitical conflict, there's another powerful force shaping the oil market this week: economic policy. While production cuts and international tensions often grab the spotlight, the decisions made by central bankers can be just as influential, if not more so, in determining the direction of global energy prices. This week, all eyes are turning to a small mountain town in Wyoming, where the world's most influential economic minds are gathering to discuss the future of monetary policy. The annual Jackson Hole Economic Symposium, hosted by the Federal Reserve, is underway. This event is more than just a meeting. It's a global stage where central bankers, finance ministers, and top economists share their views on the world economy. The stakes are high, as the policy signals sent from this gathering can ripple through financial markets, affecting everything from stock prices to the cost of borrowing and, crucially, the price of oil. Investors and analysts are watching every word from Fed Chair Jerome Powell, searching for clues about the future path of interest rates. Will the Fed signal a willingness to cut rates in the face of slowing growth? Or will it remain cautious, prioritizing inflation control? The answer could have profound implications for global markets. If the Federal Reserve hints at lower interest rates, it could make borrowing cheaper for businesses and consumers alike. This would likely stimulate economic activity, encouraging more travel, manufacturing, and shipping, all of which drive up oil demand. As demand rises, so too does the pressure on oil prices, especially when supplies are already tight. A dovish stance from the Fed would also have another important effect. It would weaken the US dollar. Since oil is priced in dollars, a weaker greenback makes oil less expensive for buyers using other currencies. This can further boost global demand, as countries around the world take advantage of more favorable exchange rates to stock up on energy supplies. The mere anticipation of looser monetary policy is already fueling bullish sentiment in oil markets. Traders are positioning themselves for a potential rally, betting that easier financial conditions will translate into higher energy consumption and, ultimately, higher prices. When you combine these expectations with ongoing supply concerns and robust US demand, it's no surprise that oil prices are on the rise. The interplay between policy, supply, and demand is creating a perfect storm that's driving the current price rally and keeping markets on edge. As the world waits for signals from Jackson Hole, the decisions and discussions taking place there could set the tone for global energy markets in the months ahead. Whether it's a shift in monetary policy or a new outlook on economic growth, the outcomes from this conference will be closely watched by everyone from oil traders to policymakers, shaping the next chapter in the story of global energy. Oil price swings aren't just headlines, they hit your wallet. When crude rises, gas prices follow, often within days or weeks. The conflict in Ukraine and US demand directly affect what you pay at the pump. Higher fuel costs ripple through the economy, raising prices for food, goods, and travel. Inflation climbs as transportation and production costs increase. Understanding oil's drivers helps you anticipate changes in your own expenses. Global events are now a key part of personal financial planning. The world's energy story is felt in every household budget. Behind the market moves is a human tragedy. The war in Ukraine has devastated families, cities, and futures. Each price spike reflects real suffering, displacement, loss, and hardship. Economic headlines are echoes of daily struggles for millions. The true cost of this conflict is measured in lives, not just dollars. Remembering the human side gives deeper meaning to the numbers we track. The oil price rebound is a lesson in global interconnectedness. War in Ukraine, US demand, and central bank policy all converge to shape the market. Each factor, from battlefield to boardroom, affects what we pay for energy. The price of oil is a barometer of global fear and hope. As long as conflicts persist, volatility will remain. Understanding oil means understanding the world's complexities. These events impact every family's budget, not just the headlines. Watching global energy is now essential for navigating today's economy.